there. And that's why I was talking about the liquidity, because at the high of the day and low of the day, you got money parked there because people are waiting for the market to come back down to those levels. When they go into the new day, right, they're going to go back up there. If I draw this across, they're going to go back up there and poke their head in there and take the liquidity out of that area. They're going to take that money, like I said before. So that positions you as an investor to say, all right, cool, I know that that's the previous high right there. So I want to position myself not to buy because that's what they want you to do. That's why we say sell high and buy low. You buy low down here. Previous high is your guide. Sell high. Instead of people buying, you sell high down here. So when it go down, you make more and more money. But we're doing what the institutions are doing because they high and low. As soon as the market's open, like I said, they shoot the price up impulsively. They make it so people, chase it. Shoot the market up, get people to think, oh, I'm missing out with the market. No, they just going to get the previous money off the table. They clean off the table because that's their job. Their job is to clean off the table. Make sure nobody makes money. That's their job. Yeah, exactly. And if you can have the mindset of, cool, I want to make sure that I'm protected at all times when it comes to trading, and know that like they not going to look out for you. They going to make sure that you don't make no money. So when you're doing this, be in and out. You take out the previous high, and I always use an analogy with this. It's like the bees. They poking at. When they satisfy, they gone. Mm-hmm. Same thing. They poking at just a little bit, and they go. And they take off. And once they do this, people that's buying the market, you're talking life savings. All type of stuff.
They're losing that money.
Exactly. Wow. Because they're on the opposite side and they don't know. Like what we know, And like I say, this is your guide because every day they're going to print out a high and low. And I literally do this to this day. Like, I'll look at the market, I'll see what they did yesterday, and I will not trade. So what I'm trying to say, I will not trade in the middle. That's why they say buy low, sell high. You sell high up here, right? And you buy low down here because this is what the institutions are doing. I want to do what they do. I want to do what the successful people do. So let's say the market is trading like this. That's a slap on the hand. You do not want to trade while it's in the middle because that's their whole game plan. They want you to, I think the market's going to go up. So they'll mess around and print a pattern right here to make you think, we're about to move. Exactly. But then you are educated because now you know the time of the day you should be trading. You know what you're looking for, and you know the whole game of, hey, sell high, buy low. This is what the banks are doing. So this is why I say the time zones are important. So today I got around 6. Some of y'all might get up a little early. I don't always get up at 6. But I only trade around a certain time of the day because everybody else is trading around that time. The banks and everything are trading around that time, so I don't want to be losing money. So if they trading in the middle in that offset time, I'll just wait. I'll just wait until London session come or New York session come because that's when they're going to make their move to the previous high or low. It could be either or. They're going to take the money, and then this is where we see the patterns at. I'm going to close out with this. Then I'll ask questions. Going back to what we talked about, when they do this, at the high price, this is where most of the time you're going to see that pattern that I'm going to talk about. I guarantee I can bet y'all $1,000 right now. Most of the time, when they go to the high or low price, they're going to form a pattern. And this is how we're able to get the confirmation, like, I need to get in this. This is it. Because they'll do it around the high and low price. If they do it in here, like I said, it's a no-no. You know that's a trap. But when they do it at a high and low price, that's the gold move. That's the golden. But like I say, you sell high. And then we're gonna talk about this, and like I said, I'm gonna ask some questions. This goes back into the patterns. And I talk about the patterns a little bit more in the course because it's more visual. I know everybody learns a little different. But like with the patterns, we know that they form around the high and low price. You got the high price, low price, right? Every day, same thing. Market might be here. Don't trade. Market may come up here. Do that. Cool. How do you take advantage of this? When you see the M pattern, I'm telling you, it happens over and over again. You sell right here, you sell right here, and you sell right here. So, you might be at the grocery store, you might be at home. You're like, hey, babe, I missed the trade. You got more than one opportunity to get on that setup. You see what I'm saying? Because, I mean, it happens to me. Sometimes it happens to me, like, I'll wake up and I already have missed this part of the M pattern, and it's patience, like I said, it takes a while for it to form, which is good. And then it'll go down, and then it'll come back up. And then on that second kiss, the last kiss, I'm able to settle it down because they gave me another opportunity to get in. So that's why I'm circling these right here. So if you take a note, visually draw the M pattern around.
Right?
This is a sell setup.
That's the sell setup. You already did the buy setup.
I'm gonna do it next.
Oh, okay.
But just remember, like, you got 1, 2, 3 opportunities to get in on that one setup. That one setup right there can make you a nice penny if you aggressive. It depends on how you are. So same thing can happen at the low price. It's a W. One right here, you buy right here, you buy right here. Sometimes, like I say, it's manipulation in the game, so they're not gonna give it to you clear as day all the time. You might see a W pattern like this. And all while they doing this is going back into what we talked about. You got money parked down here. So they probably had buyers right here. So buyers bought into it right here. So from this leg right here to this leg, you have buyers buying it up.
So let me just say something. So basically, the way you describe it, it's almost like a lot. It's like the more people they get to buy in, that drives the market.
Exactly. And that's why I started this, so y'all understand the game. Because if you understand the game, nothing can touch you. You're not going to be confused about anything. Because you're like, when they start moving, you're like, I already know what they're doing. That's why I like to educate people on like this part. Because like, if you understand this, you're untouchable. But like you said, that's the lottery. Sell your dream, buy it up just a little bit, give people the things going down. Whole time, they going to stop on the B's again, take all that money off the table, and then go up. And that prints the whole pattern. Hey, when the market did what it did today.
The foreign exchange, or Forex market, is the world's largest financial market, and it plays a vital role in the global economy. Every day, trillions of dollars are exchanged from one currency to another. This kind of currency exchange is essential for international business. Forex market participants include governments, businesses, and of course, investors. Governments use the Forex market to implement policies. For example, when conducting business with another country, whether it's borrowing money, lending money, or offering aid, a country needs to convert its currency into a foreign currency. Businesses use the Forex market to facilitate international trade. For example, they may need to convert payments for goods and services bought overseas or to exchange payments from international customers into their preferred currency. And investors use the Forex market to speculate on changes in currency prices. Currency prices change almost constantly during the week because the Forex market is open continuously from Sunday at 4 p.m. until Friday at 4 p.m. Central Time. A trading day starts at 4 p.m. and ends at 4 p.m. Central Time the following day. The market has to be open around the clock because of the global nature of the economy. Let's go over some basics of how trading Forex works. When you trade Forex, you're not just trading one product. You're trading two currencies against each other. This is known as a currency pair. The quote for a Forex currency pair defines the value of one currency relative to the other. The easiest way to understand any quote is to read the pair from left to right. Let's look at an example using the euro versus the US dollar currency pair. If the EUR-USD is trading at 1.20, that means 1 euro is equal to $1.20 US dollars. Here's another example using the US dollar versus the Canadian dollar currency pair. If the USD-CAD is trading at 1.25, that means 1 US dollar is equal to $1.25 Canadian dollars. Even though there are two currencies involved, the pair itself acts like a single entity, similar to a stock or commodity. And just like when trading stock, investors profit when they buy a currency pair, and its price increases. Investors can also profit if they sell or short a currency pair, and the price decreases. Let's look at an example. Suppose an investor thinks Europe's economy is going to grow faster than the United States, and as a result, she thinks the euro will strengthen against the US dollar. She can buy the euro versus US dollar pair to speculate on her assumption. If the price of the currency pair rises, she'll make money. Conversely, if the price falls, she'll experience a loss. Now that we've covered the basics, let's look at a few key aspects of the Forex market. We'll start with margin. When you trade on margin, you only need to put up a percentage of the total investment to enter into a position. This amount is known as the margin requirement. When you trade other securities like stocks, Trading on margin means you're borrowing funds from your broker. However, Forex trades can only be covered using funds in the investor's Forex account. Investors can't borrow funds to enter a Forex trade. If they don't have funds in their Forex account, they need to transfer funds before placing a trade. Forex margin requirements vary depending on the currency pairs and the size of a trade. Currency pairs typically trade in specific quantities known as lots. The most common lot sizes are standard and mini. Standard lots represent 100,000 units, and mini lots represent 10,000 units. Depending on your brokerage firm, you may also be able to trade Forex in 1,000 unit increments, also known as micro lots. Margin requirements can be as small as 2% of a trade or as large as 20%, but the margin requirement for most currency pairs averages around 3 to 5%. To understand how margin is calculated, let's look at an example using the euro versus US dollar pair. Say this pair was trading at 1.20 and an investor wanted to buy a standard lot or 100,000 units. The total cost of the trade would be $120,000. That's a lot of capital. However, the investor doesn't have to pay that full amount. Instead, she pays the margin requirement. Let's say the margin requirement was 3%. 3% of $120,000 is $3,600. That's the amount the investor needs in her Forex account to place this trade. This brings us to another key element of the Forex market: leverage. Leverage enables investors to control a large investment with a relatively small amount of money. In this example, the investor is able to control $120,000 with $3,600. The leverage associated with currency pairs is one of the biggest benefits of the Forex market, but it's also one of the biggest risks. Leverage gives investors the potential to make large profits or large losses. One more important element in the Forex market is financing. This is the calculation of net interest owed or earned on currency pairs, and it happens when an investor holds a position past the close of the trading day. The US dollar is associated with an overnight lending rate set by the Fed, and this rate defines the cost of borrowing money. Similarly, each foreign currency has its own overnight lending rate. Remember, when you trade a currency pair, you're trading two currencies against each other. Even though the currency pair acts like a single entity, you're technically long one currency and short the other. In terms of financing, you're lending the currency that you're long and borrowing the currency you're short. This lending and borrowing occurs at the overnight lending rate of each respective currency. In general, an investor receives a credit if the currency he is long has a higher interest rate than the currency he is short. Conversely, an investor is debited if the currency he is long has a lower interest rate than the currency he is short. Let's look at an example. Suppose an investor has a position in the Australian dollar versus the US dollar currency pair. Say the overnight lending rate for the Australian dollar is 2% and the overnight lending rate for the US dollar is 1%. The investor is long the currency pair, which means he is long the AUD and short the USD. Since the AUD has a higher interest rate than the USD, the investor will receive a credit. However, if the investor was short the AUD-USD currency pair, he'd have to pay the debit because he's short the currency that has a higher interest rate. Financing is performed automatically by your brokerage firm. However, it's important to understand how it works and its financial impact on the trade. We've reviewed just a few elements of the Forex market. As with all investment opportunities, the Forex market has a unique set of risks and benefits, and education is the first step to determine if this is the right opportunity for you.
Hey, what the market did what it did today? All right, y'all. So let's go ahead and jump right into this. Good morning to all you guys. Hope you guys are having a wonderful day so far. Hope you guys are learning something. Hope you guys are investing into yourself at that. So we're gonna go ahead and jump right into it. If you guys got any questions as we jump into this, please don't hesitate to ask questions or, any concerns or whatever you might have, all right? So, if you guys been tuning into the live session every single day, right? Even this week, we talked about the most important things on how to make money with Robinhood, with, MetaTrader. It doesn't even matter what platform you utilize, it all is the same. All right. So if we're talking about the simplified things, remember what I said. So let me go back into that real quick. Remember what I said
from the beginning of this week. The markets do the same thing over and over and over and over again, right? So if they do the same thing over and over again, why can't you take advantage of the things that's happening over and over again, right? So my question for yesterday was, hey, where is the money? If anybody can tell me where is the money, then you're halfway there. And what I mean by that is, if you can locate where the money is located at, as far as liquidity within the market, then you can be a profitable investor. Why is that? Because the market always establishes a high and a low of the day. I repeat that. The market will always establish a high and low of the day. It don't matter if the market doesn't even move, right? The market is always going to create and generate a high of the day and a low of the day. Watch this. Let me get this right real quick because I spelled that incorrect. So let me fix that real quick. You guys with me so far? So we got a high of the day, right? And we got a low of the day. And this is how we're able to make money. This is simplified. There's nothing more complicated about this process. This is simple. We got a high and low of the day, right? Now watch this. This is the previous day's low, right? And this is the previous day's high, right? Boom. They've already established that. Now that we know that, hey, this is the high and low of yesterday. Now, let's say the market come in here and they trade in the middle, right? Like I told you guys before, we do not want to trade while it's in the middle, while it's in a range-bound market. Why is that? Because it goes back into the three pillars we talked about. It being risky. A lot of you guys not investing because you think it's risky. You're not educated, and that's A-okay, right? But what we're waiting for, right? We're waiting for the market to come either to the high price or to the low price. If they're in this middle zone right here, let me label this off for you guys so you can see exactly what I'm talking about. If they are in the middle, right, of this high and low, see the high and low of yesterday? If they're in the middle of that zone, I do not want to trade. I do not want to invest my money. I want to wait. I want to wait until the price comes to a high price. So going back to that terminology all of us heard of, sell high, right? I want to wait until they come to a high price so I can sell it at that high price. Or I can buy it, right, at that low price. And at the same time, while all of that is happening, the market is a $6 trillion market per day because they're facilitating order flow, right? Their job is to facilitate order flow, find the money, and go to the next money spot. So if they come to a high price, right, they take the money off the table, right? So they came up there, boom. They took the money off the table, right? Y'all seeing this? Boom. Money taken off the table. Liquidity taken off the table. And once the money has been taken off the table, guess where they going? They going to the opposite side, to where the money is. So if it's money down here, that's exactly where they're going to go. And they won't just stick their head in there one time. The market is very given. And that's why I say that investing is not hard. It's not time consuming. Because the market is going to give you more and more opportunities to get a crack at these opportunities. So they went down there. So I'm going to highlight this for you guys. So look, you see how they went into that money? I like to call it the money pool. Like a pool of money, right? They dipped their head in there, right? And they went up. And they're going to come back down. Uh-oh, I did something different. All right, so they're going to come back down and give you another opportunity to buy low. And at the same time, it goes back into the patterns that we talk about. And we're at a low price. So we know that we are in a great, solid setup to invest our money. Why is that? Because we're at a low price. And we're going to see this. We're going to see a W pattern. And that W pattern is going to be your best friend. That W pattern is going to be your confirmation that you need to get into the trade right now. But listen to me, y'all. You only get into the trades if we're located at a high or low price. I'm telling you now, you're going to see these patterns everywhere within the market, but not everywhere is gonna be, a valid pattern. All right, y'all with me? Y'all got any questions? So look, we're buying low, and up here we're selling high. If you guys can understand the whole game, then nothing can confuse you. Now I want to jump into a live market. This is the British pound versus the US dollar. The same thing I just talked about, we're seeing live. We're seeing it happen live right now. Right? I don't know if you guys can see this, but I'm going to paint the picture for you guys. Look, we're at a low price, right? Buy low. And this is a live market, as you guys can see the market moving, right? So look, this same W pattern, and you can see the market moving. Look, it's moving very, very rapidly too. So let me stretch this out so you guys can see this. All right, so I'm gonna sit this right here so you guys can see this. Live market. So I'm not making this up. We're at a low price, right? This is a great time to buy low. So if you guys got a broker account or you're trading, hey, jump into this trade. I got a question. Somebody said, how do you know when to sell? So that's a great question. When you are at a, how do you know to sell is when you're at a high price. So let me go back to that. So this is the W pattern, right? It hasn't happened yet. We're waiting for it to finish off. So I'm going to go back to that question I just got. Somebody asked me a question, all right? So let me go back to that. So how do I know to sell is when we're at a, trying to get this thing to, I don't want us to be great. All right, so let me see if I can get this thing to, all right, here we go. All right, so that was a great question. How do you know when to sell? So to answer your question, let me delete this real quick. Not all of it, but just some of it. So I just broke that down, and I'm going to break it down one more time. So how do I know when to sell, right? So let's just say the market is, like I said, you're using the previous day's high and low. So yesterday was Tuesday, right? So let's say yesterday, this was Tuesday's high and low price. That's what they did yesterday, right? Watch this. That was a great question. So let's say that they come back down, right? This is today, Wednesday. We know what happened yesterday. But all today, Wednesday, let's say that we're trading in the middle of the high and low of yesterday. How do you know when to sell? We wait. Listen to me. This is your question, right? We wait. If they're in the middle, which they are, right? We wait until the market come up to the high price, right? We're looking left. You see the high, right? If they come up here to a high price, right? And they give us confirmation with an M pattern or head and shoulders or some type of confirmation, that's when I know when to sell, to answer your question. If I do not see this, then I do not sell the market. I do not even participate in the market. I just move on to the next stock, currency pair, whatever it is. Does that answer your question? So I wait until it comes back up to the high price, and they have to give me confirmation that that's what they want to do for me to sell high. And the same thing with the buy low setup. So right now we're seeing a buy low setup. And going back to your question, how do I know when to get in? I wait until they give me confirmation with the pattern. If I do not see a pattern, which is my green light to get in, I'm not getting in. I'm not going to trade. I'm going to wait until, the opportunity presents itself. So that's exactly how we go about it. Like I said, this is a live market and a great example of, buying low. And if I answer your question, I appreciate you, answering that question. Look, if you guys are getting value from this video, just imagine when you guys get the course. I recommend all of you guys get your copy of the course. You're going to learn some $1 trillion, $1 million information, guaranteed. If you're getting value from this, just imagine us breaking it down in the most simplified process, right? So we wait. We don't sit here and watch it. We keep it moving. So I got that marked up already. You guys see this, the British pound? I'm waiting for that to play out. So I'm going to go to the next, right? Now we're going to go into an index. Now, this index right here is the Dow Jones versus the industrial average. I always say versus. So we got the Dow Jones industrial average, and let's see if we can find a pattern. All right, so this has already happened, but I want to show you guys this pattern right here. Don't worry about this. Focus on this part here. Now, we've already, I don't know if you guys can see this, but we've already got a M pattern out of this move here, right? So boom, and you can see it just fell off the face of the earth from that point, right? So let me draw the arrows. You're not always going to be able to position yourselves at the very, very top, but we just want to give you guys the right, education. So double top, they tap it twice. Remember I said they're going to give you more and more opportunities to get in, right? So they went up there the first time where that first red arrow was, right? Then they dropped the market 3 candles down, and then they went back up to that same spot and gave you another opportunity to press that sell button. Get in, right? And they went down. And you can see the market just fell off the face of the earth from that point. Let's see how many pips or points that was. That was a lot of points that the market has went down. So, wow, that was 595 points. So you do the math. 595 with just $1 invested. You do 595 times 1. You would have made $595. And not saying that if you would have invested a little bit more money. 595 times 5, you do the math. That adds up. 595 times 5. That's $2,975 you would have generated and profited simply because you have a skill set that you know about. So that was an M pattern, right? Let's go into the NASDAQ. Now the NASDAQ is on a whole nother level. But before I show you guys that, they're also, printed out a M pattern here as well. I'm just trying to show you that these patterns are going to be your best friend. And this is what makes investing, simplified for a lot of people. Right here, this was yesterday, by the way, we had a nice sell high opportunity, right? And you was able to press the sell button. And as they fell off the face of the earth, boom, it went down, you made money. Get out, you're done, right? But on a bigger scale of this one, we're seeing the bulls pretty much have full control over this one. We talked about this yesterday, and overall, we are looking for the bulls, to continue the trend up, right? There's only bulls and bears involved in this. Sellers and buyers, that's it. All right? So this head and shoulders, this pattern is just like that W pattern and that M pattern that we just talked about. This is our confirmation that gives us, the green light. So if I drop down, right? Let me show you guys something. If I drop down, and I know this may look a little confusing for some of you guys that's new to investing, but check this out. Within this right shoulder, you see it says right shoulder? Within that right shoulder, we're seeing a W pattern. And this is going to feed back into the overall goal of what we're looking for, and that's for the buyers to take over. And you can see the W pattern is going to complete itself, right? And at the same time, watch this. Watch this, y'all. Watch this. At the same time, when that completes itself, that's going to complete this head and shoulders pattern. So it's money time. And we're going to keep this video short today. But listen to me. If you guys want to be a part of this inner circle, if you guys want to learn this information for yourself, for your family, you got goals and dreams and aspirations, whatever it is, listen to me. You have that same opportunity to get the course, to invest into you, to learn some information and get the knowledge that's going to make you money from this day forward. Hey, if it's not for you, keep it moving and say, okay. Like I said, we're only here for the select few people who's going to see this and take advantage and be that advantageous. Because at the end of the day, like I said before, investing has been the culture. It's a no-brainer. Get invested. You can make money off the corporations that you shop with. I just don't understand why people don't understand that, but I'm going to say this on me going. You can make money off Facebook, Amazon, Tesla, Walmart. It don't matter what company, corporation it is, you apply the same skill sets and you're able to make money. If you don't know how, we're here to help you. But we can't help you unless you invest into yourself, because you're showing us that you're serious. If you're serious, then we're serious. All right? So with that being said, I love y'all. It's your boy, Mr. 120 Dreams. I'll see y'all on tomorrow. Holla.